This is America's Roundtable. Visit us at americasrt.com. Follow us on Twitter at americasrt. You can find us on YouTube and Facebook. Like and share. We are pleased to be joined by Dr. Steve Hanke, a professor of applied economics and co-director at the Institute of Applied Economics, Global Health, and the Study of Business Enterprise at the Johns Hopkins University in Baltimore.
You remember the Queen of England, Queen Elizabeth asked, after the crisis started, she drug in a bunch of economists and said, well, why didn't you see this thing coming? And of course, they're fumbling around with some nonsensical arguments and giving the poor queen trying to give her a snow job. And if I was there, I would have just said, well, sorry, we just had the wrong tools to analyze the thing. Our models didn't include banks, and banks were what was leveraged up. Now that means they have a small amount of equity capital, and that's on the liability side of their balance sheet, but they have a huge amount of assets. Most of these things were leveraged. The ratio was between 30 and 40 to 1. And you say, well, why were they so dangerous? Why did they get so dangerous? Well, they did it because of the Fed. You asked Natasha originally, you said, who caused the thing? And the Fed caused the thing. It enabled all these bad things to happen. Because why did banks leverage up? Why did hedge funds leverage up? They were doing what's called chasing yield, because once the Federal Reserve pushed the interest rate down to 1% and left it there for a year, well, you were chasing around trying to find something you could earn a little rate of return on. You see, 1% is not a large number. So you're chasing around trying to find out where you can make a little yield, and that pushes you into, number one, more and more risky things, because risky things do have higher yields.
Right.
Of course, they tend to blow up too from time to time, but they do yield more interest. So people were chasing the yield, and then if they found something where they could get a little interest pop, they would borrow a lot of money and leverage. That's what the leverage thing is. That's the 30 and 40 to 1 kind of thing with the banks. So they would borrow money so they could purchase assets that yielded a little extra yield. And by doing that, of course, then the return on their equity that they have invested, that you can blow that up and make it fairly big. So this is all the speculation that was going on, and all the complaints about hedge funds and banks and everything is in a way
incentives were
beside the point. It's beside the point, because the central bank had forced them into that situation, or they enabled all these things, bad things to happen.
Right.
By pushing the interest rates down so low.
Right. Dr. Hanke, in addressing how to contain this crisis and turn the things around, in your recent article that appeared in the August 2012 issue of Global Asia, you mentioned that heads of state continue to focus most of their rhetoric on whether fiscal austerity or more fiscal stimulus is the right strategy. And you say, instead, they should be focusing on the monetary supply. Could you kindly explain your solution to our listeners?
Yeah, the reason I said that is the reason I answered your first question, that the central banks caused things by too much money. and now we're in a situation where in most countries, with perhaps the exception that you've got China, Canada, Germany, those are okay as far as the money supply goes. But all the other countries, including the U.S., the deficiency in the money supply maybe is at 10%, 10 or 11%. So it's too low, and that's and money is the thing that dominates the fiscal policy. It dominates everything. In other words, whatever is happening to the money supply is going to call the tune on what's happening in the economy. In short, now let me just tell you why it dominates, and then I'll answer directly your question. But I think we've got to lay out here what's going on. In the 1990s, Just take the 1990s. What happened in Japan? Well, Japan had a huge fiscal stimulus, one of the great fiscal stimulus programs in the world. That means government spending was increasing and deficits were exploding in Japan. But the money supply, so on the fiscal side we had stimulus, but we had contraction on the monetary side. The money supply wasn't growing in Japan. What happened? Well, they went into had huge deflationary pressures, and they lost a decade of economic growth. I mean, Japan did not grow in the 1990s. And they had a bubble, of course, that popped at the start of that decade. Now, in the United States, what happened in the United States? Well, we had President Clinton. Bill Clinton was the president, and Clinton was the most austere president in modern history in the United States. He was taking government as a percent of GDP. He was squeezing it and squeezing it down. He took 4 percentage points off government expenditures relative to GDP in his 2 terms as president. So there's no one even close to that in the United States of modern history. And in the last 2 years of Clinton, he actually the federal budget was in a surplus. So he was squeezing. It was very tight, very austere on the fiscal side, but the money supply, as I've talked about before, was accommodating, loose. And the economy boomed. We had one of the greatest booms in the 1990s in the United States ever. So that's the money dominates argument. And we come to today, and people are arguing on and on about, well, should we have more fiscal stimulus? The liberals make arguments for more fiscal stimulus. This is their argument. The conservatives on the fiscal side want more austerity. They want to shrink the government, shrink the deficit, and so forth. Both sides are essentially irrelevant, because what is going to dominate is the money supply growth, and that will determine how the economy does. And the big reason that the economy has not done very well is due to the fact that the money supply has in fact not been growing very rapidly. Now, many people will say, oh, the professor doesn't know what he's talking about. The Federal Reserve's balance sheet is increased by 3.5 times since the Lehman collapse. The explosion in what's called high-powered or base money, or what I call state money. That's the money the Fed produces. But that's peanuts compared to the amount of money that's created in the banking system. The banking system creates now, today, about 85% of all the money in the economy. That means checking the accounts, checking deposits, is created by the banking system, and the Federal Reserve is creating a very, very small amount, about 15%. Of the total money supply in the economy. So even though the Fed is exploded its state money production, the total amount is deficient, because what's happened is that you've had a shrinkage in the amount that's being really produced by the commercial banking system. So that's why the economy is so sluggish. That's why we might go into another recession. Now, added to that, there are some very serious structural problems, and this started with the Bush administration. It's been carried over by the Obama administration, even gotten worse with the Obama administration. And that is more government regulations, more red tape, more uncertainty. No one knows what they're going to do from 1 week to the next in Washington, D.C. We passed this Dodd-Frank financial regulation legislation, and it's a huge piece of legislation, thousands of pages long, and there will have to be regulations written around this. No one knows what the regulations are. These all impact banks, and that's why banks are hunkered down, and that's why we ironically have a situation in which the Federal Reserve is very expensive, although the amount the proportion of the state money they create is a small portion of the total amount. They're still very expensive, but the private side has been contracting in the money supply picture. It looks the way it does. Mainly, this is due to financial regulation, financial uncertainty, and so forth. So we actually have a credit crunch. At the same time, the Fed has produced a lot of state money. We actually have a credit crunch. It's hard to get a loan for people wanting to buy a house, or even though interest rates are very low on mortgages now by historical standards, it's very hard to get a mortgage now. The tests they require you to pass before you qualify for a mortgage are much more stringent than they used to be. So even though there's a pot of gold out at the end of the rainbow for anyone who wants a mortgage, if you can get one, they're great because they're very cheap. And clearly, in fact, if you adjust for inflation expectations, a mortgage now, it has a negative rate of interest.
Right.
The real rate of interest you're going to be paying on your 30-year mortgage will clearly, in my opinion, end up being negative. It's like you're getting a gift, getting a mortgage, but you can't get one.
In your article, actually, you have recommended a solution how to increase monetary supply, which would not be actually through debt market operations.
The solution would work in the following way. There are many variants on this, but the most simple one I illustrated in my article in Globe Asia that you mentioned, and that would be the following operation. Now this one, the key to remember is this operation will increase the money supply, but not increase the federal government's debt.
Right.
And so these are the steps. The first thing is that the federal government would go to commercial banks and borrow money from them. So the exchange would be they would give short-term paper, short-term bond to the bank, and the bank would increase the credit, the checking account of the federal government. And then the federal government would take the credit that they have in the checking account, and they would go to the public, and they would buy long-term government bonds that the public hold. And the exchange there is, of course, their checking account would go down, and the checking account of the public that's selling the bond would go up, and then the government gets the bond back, the long-term bond. And why would the government be wanting to hold on to a bond in which they owed themselves money? I mean, they would just cancel the bond. I mean, to shred it basically.
Right.
So what you would do by that operation is the bottom line is the public would have increased credit in their checking accounts. That means the money supply, because a demand deposit or checking account is the money supply. That's the biggest part of the money supply. It isn't dollar bills and notes and coins, that kind of thing. It's checking.
Right.
You would end up increasing the money supply, not increasing the debt, and to some extent you would be substituting short-term government debt for long-term, because you would be extinguishing the long-term debt that you would be buying up.
Right. Let me summarize just for our listeners. So government borrows money from commercial banks and uses that money to buy back the long-term government bonds from the non-bank private sector. The government debt is the same, it just changed the maturity. There is more money in private sector hands, which is deposited in commercial banks. So practically there's more money supply.
If you had a long-term government bond and you sold it to the government, then your checking account balance would go up by the amount of money that you were paid by the bond, for the bond. And that's how you are increasing the money supply. Now, the question is, well, what happens then? And typically what happens is that you try, and you and other individuals and other households and businesses in the United States and elsewhere, they keep more or less a constant ratio between the amount of cash that they have, or real liquid assets, and the amount of money that they are, and the income that they're earning. So if the amount now, all of a sudden your liquidities have gone up because you've gotten rid of this long-term bond and you've got cash basically. What do? Well, you try to adjust the ratio between cash and the income that you're earning. Now, let's assume your income stays the same. You've got a good job and your income stays the same. But now you've got a bundle of cash. So the question is, well, what do you do with the cash? Well, you might use it for consumption. You might invest with it, or you might decide to actually save some more and run down your debt. But you see, that's what's happening to you. If you have more cash, the incentive is, and the tendency is to try to rebalance your portfolio so you get the cash income ratio back down to where it was before. That's why there's a very strong link between the money supply that's out in the economy and the nominal GDP numbers, let's just say, that you see.
Right.
In other words, there's a link between the money supply and economic activity. That's why there's a link, because there's this ratio that you're trying to keep constant.
Right. Practically, the public non-banking sector will get more money that they would spend through consumption, through investments that will increase economic growth, that spur more economic activity. We would be able to avoid the credit crunch because the banks would be more willing to grant loans in a higher economic growth, more activity environment, and it would pull everything up.
It would pull everything up. But by the time you put all the pieces together, the story starts getting a little complicated, and that's the basic idea.
Right.
And some people would say, "Oh, well, that's going to be terrible. We're going to have more inflation." Now, at least for now, that's not much of a concern for me, because if you look at the rate of growth, the trend rate of growth since, let's say, 1999 for the U.S., and look at a trend line, right now the money supply today is actually in reality maybe 10 or 11% below where the trend line would have you. So that's why I think there's a deficiency in the money supply, and that's why if you look at all the forecasts, they keep revising the GDP numbers down, and this last quarter, was very low, it was 1.5%. Extremely bad performance, and there's a pretty good chance that we could even have a negative number. And why is that? It's because of this money supply deficiency.
Right.
It has nothing to do with all this nonsense people are talking about, the fiscal policy, and all of a sudden we're running out of fiscal juice. We had this explosion of fiscal juice that started with Bush, really. George W. Bush, his administration, the last couple of years were essentially out of control. As